The average investment advisor, mutual fund company, or professor of finance will tell you that understanding the relationship between risk and reward is crucial in making educated investment decisions. And they would be right. However, they would then show you this theoretical chart to illustrate the relationship between risk and reward. You've probably seen this before. Point A would be the least risky but the least rewarded choice, whereas B would be the most risky and most rewarded. The message they want you to remember is that as your risk increases, so does your reward. But what is this chart actually demonstrating? It represents a snapshot of any theoretical investment at a specific moment in time, and this technique is inherently flawed. This is Cornerstone's theoretical risk versus reward chart. The main difference is that the bottom axis is not risk, it's time, and the side axis is not reward, it's value. In fact, we take it a step further and break value down into a range from undervalued to overvalued. Which point would you say has the most potential risk? Which point has the most potential return? Most investors guess that A has the most risk while B has the most return. But this isn't the case. A is at the bottom of the cycle, so it has the least risk with the most potential return, whereas B is already at the top of the cycle, so it has the most risk and the least potential return. The chart only goes up from point A and only declines away from point B. Going back to the traditional chart for a second, you will notice that risk and reward always seem to be in balance. On many charts, it is a one-to-one relationship. Back to Cornerstone's chart, and you can see that the only time risk and reward are in balance is at points X and Y. And you can clearly see that X is on the rising part of the cycle, while Y is on the declining side. The traditional chart fails to indicate whether the cycle is rising or falling, so while the investment might have the appropriate risk-reward relationship on paper, you have no idea which side of the cycle it is on. Remember, this is a theoretical chart, just like the traditional risk-reward chart, so there are no numbers or scale. This theory can be applied to anything that has a cycle: stocks, bonds, commodities, real estate, collectibles, you name it. This is one of the founding principles that guides Cornerstone's investment strategy. Risk and reward cannot be simplified and analyzed in a vacuum the way many would like you to believe. The cycle should be accounted for. We believe the only way risk and reward can be properly understood is through an analysis of the investment's cycle. We hope this perspective will change the way you view the traditional analysis of risk and reward.